So we're going to do, as we've done in other panels, I'm just going to ask you just to go along and just give a little bit of a kind of 30-second explanation about what your platform does and your own background. And I'm going to pick on you, George, first, because you're closest to me. George, explain a bit about what you do and who you invest in.
My name is George King. I'm here from New York, so really enjoying my first trip to Australia. My company has three objectives. First, we do asset management. Second, principal investments. And third, we do corporate strategy all around fintech. Company's 5 years old, and last year we launched our first multi-strategy hedge fund, and we invest in SME platforms. So that's my perspective. In terms of investments, we have 10 principal investments. 8 of those are in the US, and 6 of the 10 are in fintechs.
Dermot.
Good afternoon. My name is Dermot Crean. I'm one of the founders of InvoiceX. I've had 30 years in and around private equity growing companies. 25 years of that's in London. I finally escaped with my Australian wife 5 years ago, and life's pretty good. So what we're about, we're in our third year. We spent about a year just doing legals, by the way. Oh. We fill the working capital gap, which is pretty massive for Australian companies looking to grow. And there are 3 things about us we think are different. One, we're the only confidential invoice trading platform where you can turn high quality receivables into cash from sophisticated investors. We're not a retail platform. The second thing is size. We do up to about $5 million in facilities. Our target companies have revenue $5 to $50 million. And the third thing is skin in the game. In fact, we've got whole bodies in the game. Us, the 2 founders, are pretty important investors. We're the largest investors on the platform, will be for some time. And actually, as a final point, because I only had 3 points in mind, but we have a partnership with BDO so that if anything happens to us, BDO have complete accounting records in real time, which makes us feel very comfortable.
Leo, bit of background of you.
Just check it's working. Hi, my name's Leo Tyndall. I'm the founder of Marketlend. Marketlend was established in December 2014. We essentially are trade credit, I would say. That's what we focus on. We do either 2 options. We offer supply chain finance or debtor finance. What sets us a little bit different apart is that we run an auction system for each of the listings, and we also invest. We invest in every loan. What we also have is that we do have an insurance policy that we place on each of the debtor finance facilities. We're in negotiations with our insurer to also look on the supply chain as well. We're at the moment 3.3 million, and at the moment, fingers crossed, we haven't had a default yet. We've had a few, debit dishonors, and we're dealing through that. As far as data, we actually released our data as of December. It's actually easily and it's publicly available on the statistics website. Interestingly enough, we saw the traffic on our site grow significantly after we did that. And then outside of that, we just continue to grow. We just took on a major investor as of Friday. I can't mention his name yet for press purposes. However, he was involved significantly in setting up a large fund that's invested in a number of peer-to-peer platforms, and he's coming on as a director as well as an investor.
Sunil.
Thank you, David. And is this working?
That's working.
Thanks a lot for all of you being here today. Basically, ThinCats UK is our parent and a joint venture partner. ThinCats Australia is a peer-to-business lending platform, and we essentially look at term loans between 2 and 5 years for growth finance, and so there has to be positive growth outcomes, and rates set between, say, 12 and 15, 12 and 16%. And our loan sizes upwards of sort of 100,000 through to 2 million. So we're kind of very niche in terms of where we're positioned. And we started up last year, and we've targeted this year as being our year of growth to achieve a $20 million goal, and next year we should be aiming for much more than that. And I'm sure I'll get a chance to differentiate our business as we go through the questions today.
Okay, great. So you all represent, and George, you're in a good position here because you invest in lots of different types of businesses. A good spectrum because we've already talked a lot about SMEs, so I don't want to go over some of the ground we've already talked about. But one of the ideas that we really haven't sort of talked about is that there's a capital cycle for businesses. Just like businesses have a life cycle, they have a capital cycle, and they need capital for different things at different times. And some of you represent the short end of the working capital curve. Some of you represent the longer end of the working capital curve, and some of you represent stuff in between. Where's the most demand? Is it in term, or is it in shorter duration? Do people really, you see, my impression is, talking to a lot of businessmen, actually, what they really need is they need cash now.
Can I take this?
Anybody, go for it.
Wonderful. In terms of, I'll step one step back from that, and that's really what is the demand.
Yeah.
And if you look at the Australian sort of SME market space, there's $73 billion of money lent each year by the banks to SMEs, the 2.1 million SMEs. And I think 91% is controlled by the Big Four, and they largely lend money to SMEs on the basis of property.
Yep.
And so with property securing those loans, it doesn't really matter whether it's short or long term, because it's the property that's arguably a building society sort of activity. On the other hand, if you look at businesses and ask SMEs what they need more than what the bank would give them or the value of their assets in order to achieve or to capture that little growth opportunity that they got, usually it would be anecdotally 10 to 20% more. And Morgan Stanley did some work on this last year, and they came up with a figure of $10 billion. So there's $10 billion of unserviced demand for growth capital to bankable businesses that don't have enough assets for the banks. So that's one angle. The next question is in terms of working capital versus longer term debt. And I have to say, from my personal standpoint, I think the concept of short and long term debt is more an invention of the banks who buy and sell money and need to worry about how long they should buy it for or how shortly they should be matching their balance sheets. From our perspective and from a small business's perspective, it's they need money to actually either use it for working capital or to use it for an acquisition or to get a new business or to for whatever period they might
Even
need.
asset-backed finance,
Exactly.
equipment finance. Yeah.
As long as they can have a growth outcome which will allow them to earn enough money in a net profit sense, or quite simply, if I may indulge you for a minute, if someone borrowed $50 in working capital and was able to turn it over 4 times and their cost price was 50%, they should sell $400 more. And if their GP was 25%, they should make $100 more of GP. So in a simple sense, they're able to then pay interest on that because they made money. So effectively, I'm quite ambivalent to short or long term in that context.
Gentlemen, else I'm guessing you might think that it might be like the shorter end of the duration curve.
Well, I suppose what I would say is it's a little bit balanced on demand and supply. So when we speak to borrowers and we try to understand initially what they're looking for, our reaction firstly to them is to say, well, okay, how long do you want? And they'll sort of give us an idea. Then we'll say to them, well, look, what is investors going to expect and what they're going to take up and what's going to be most successful in the platform. So we give them some guidance, and then we'll say to them, well, look, 12 months' time, if you come back and you've done the right thing and the like, you could possibly put up a new listing and you can replace that loan with another loan, or you pay it out at that time. In some cases, you can even go back to those investors and say, look, I'd like to extend that for another 12 months. And so what I would say is, I think from our side, what we've seen on the investor side, they're not too keen on too long a term. They want to sort of have a bit of a litmus test and see how these businesses are going.
Can I, I don't want to sound old-fashioned, but we're talking to a lot of SMEs. A name keeps coming up called a bank overdraft. Basically, if I were to sit down and talk to most SMEs what they want a bank overdraft. Well, sorry, take the bank out. They want an overdraft. They want a rolling facility to be able to borrow money every year. That's what they want. They don't frankly, the idea of securing it against anything we're invoiced, they don't really care about that. They want an overdraft. And the first person who brings it to them will get business.
Which is what we give them.
I couldn't agree more. I mean, if you want to grow a $5 million business to $10 million and you've got large customers, right now you have about $750K in accounts receivable.
Yep.
Guess what? In order to double your business, you need another $750K.
Absolutely.
And that's not a temporary phenomenon. But if you speak to an SME, they need whatever they need tomorrow. They're
Yep.
not thinking about next year,
Yep.
and they don't know whether it's going to be 10 million. So having access to revolving credit that grows, we're very passionate about that in a flexible way, so you get the money when you need it to grow.
Completely, George.
Yeah, David, I think comment I'd like to make from the investor perspective. Duration is fundamental to risk. Duration is fundamental to credit risk. So I think what the platforms are telling us is that the businesses out there want the working capital. I think you're correct. What I'm saying from an investor point of view is that an 18-month working capital loan payable daily, weekly, monthly is fundamentally different than a 3 to 5 year credit risk. So I think that's something to take into consideration. I think the investors are very happy with short-term duration, especially in a choppy market, because it means their funds cycle faster. And as rates go up or credit changes, they get their money back and their platforms are able to redeploy it into the current market. If you put a 3 to 5 year duration out there, you're kind of out there for better or for worse in terms of how things evolve. And things are pretty choppy right now.
I think just to sort of, in our case, we have all our loans are only principal and interest from day one, and we actually provide quarterly updates to investors on the financial performance of a company, and we have covenanted sort of growth outcomes. If are not met, the loan would be defaulted and demanded back.
Another old-fashioned term, which I quite like to bandy around in these conversations, is personal service, which I don't mean, by the way, illegal services. But personal services, I mean picking up the telephone to somebody and talking to them. Got an old-fashioned idea. Sorry to talk about it in a room full of fintech people. But I mean, for instance, I mentioned earlier, we bank with a bank called Handelsbanken in the UK. No one will have heard of it in Australia. It's a Swedish bank, but they operate in Britain. They have 150 branches around Britain. They are phenomenally successful in the SME sector. And the reason they're phenomenally successful is their technology is shit. And you can pick up the telephone to your bank manager. Mine's called Rob. And I can say, Rob, you know what? I could fancy having a bit of a bigger overdraft. And he'll laugh and say, no, you can't. And then eventually I talk him around and he'll give me an overdraft. But I'm only being half facetious because the reason I ask this question is because the main banks in Britain don't provide that service either. Right, that's a lie. They don't do that, yeah. And Handelsbanken are about the only bank that does do it. So they're traditional banking. The personal service model could work with technology. There's no reason they have to be separate. I.e., and we've talked about this, George, actually, with savings and loans associations, community associations in America. There's lots of small banks in America that do have remarkably good personal relationships with customers. Lots of credit unions that have really good relationships with customers, yeah? And they would probably quite like, they can handle the personal community banking aspect of it, and they'd probably quite like to work with a platform that can facilitate and wholesale this. And if you could do that, you've got the killer thing for SMEs, because SMEs want to talk to someone.
Actually, just on that point, David, we started thinking we could scale just online.
Yeah.
We found the best customers are the ones we meet face to face.
Yeah.
And it is our business is very much a sticky relationship type of business, even though it's all online and it's super fast and no hassle. That meeting people and being able to take a call at 8 o'clock at night and saying he's got a contract to build a $20 million exchange, people go for business because they know they've spoken to someone who, yes, you've got to go through the normal process, but you've got someone who's saying, actually, no, that should fit. We'll have to run it through the model, but you'll get an answer quickly.
Yeah, David, you wanted some of the international perspective on this, and I think there's really a number of threads from today and some lessons from the US that we can all pull together really fast. There are 7,000 credit unions in the United States. There are 7,000 community banks in the United States. And David was saying, what about the Googles and the Apples and the relationships they have with the customers? And that is real in the United States, and they are displacing the established financial institutions in terms of relationships. So you have this very, you could say fragmented, but on the positive side, you've got this incredible opportunity for choice for the small business and for the consumer, okay? So how do the institutions take advantage of that in terms of creating the right partnership between the technology-driven companies, like Noah was saying, 2,000 different data points for every customer, all the thousands of different things that On Deck looks at, and the other companies in the space that also have these same credit models. So you've got those technology companies driving that. You've got the 14,000 community banks and credit unions that are close to the customer. It comes back to those strategic partnerships that you said before, and which companies make those work and which ones don't. And that also brings your cost of origination down, which is what kills profitability.
And sorry, go for it, and I'll ask you in a second.
You brought up personal service, and I suppose we focus a lot on that. We have essentially the first thing we set up was a call centre, and not only that, but people here on the ground. For us, we actually touch the borrower about, you would say, probably about 6 times. So when they first come in, they put the application, we ring them. Then after that, they put the application through. We'll actually talk to them on the closing. We'll even give them updates as where their listing's going when they go to close. And we've actually turned around and stopped 2 loans because when we went to do the settlement, we called them and we weren't happy with the answers. They came back there. And then a lot of repeat business we get is actually through calling them and doing, like you said, ringing them up, finding out what they need, and then going forward. So it's very big for us.
I'm sounding a bit of an old-fashioned type, but another old-fashioned concept called finance brokers. Now, whenever we do our events in Europe, at least half the audience says, it's amazing, we're going to come up with a model that disintermediates finance brokers. And then the other half sit there smiling, not going, no, you won't. And actually talk to a lot of the SME-orientated platforms, and they all started with the model of, we'll get rid of those rubbish finance brokers. And then they all go, actually, no, we'll probably get 80% of our business from them. Finance brokers, effectively, you guys would all be dead without finance brokers, wouldn't you?
I suppose a little bit with us is that we're trying to get all our knitting right before we actually go bigger. And as more funds come on board, we'll start going directly at finance brokers. Finance brokers have come to us, we've taken loans, and we've been quite successful in the relationships with them. But we haven't gone out there saying to all the finance brokers, here's a product, particularly because you've got to really make sure you have the funds there.
Yes.
And we do have funds, but we don't have funds to start taking on 20, 40 million yet. So we're a bit careful with that.
David, actually, just to go back to your last question as
Yeah,
well,
as well.
because it all rolls into this.
It's all the same question, exactly.
In terms of what we do, and I suspect many of the other platforms might but may not always say it, is that we are really old-fashioned business bankers that happen to use technology to enable what we do in terms of delivery to an investor, in terms of their dashboard and their investment sort of position, as well as evidencing of credit information. And what I mean by that is you can actually use big data analytics, and you can have sort of APIs into banks to get bank statements, and you can use some analytics to get sort of social media based sort of results in some form. But in a risk weighting sense, I'd suspect the ultimate credit decision has to come down to individuals.
Absolutely.
And so if you look at any of these companies that are very, very sort of, I guess, tech orientated, you'll probably find a lot of guys in the credit department ticking boxes, and I'd wonder why. The other aspect, I think, is in the context of fintech. When you talk about business lending, it's a whole lot of fin and a very little bit of tech. So from a broker standpoint, just to bring them into context, going back to your point, brokers are the guys who hold the relationships.
Yeah, exactly.
And if they hold those relationships, then they are a very valid channel.
An interesting challenge comparing with, say, the UK. What I found, I was surprised, residential property is such a big feature of the Australian finance landscape that resi brokers are very dominant, and commercial brokers have found it pretty tough. So we were dealing with a fairly senior commercial broker, and he asked someone from one of the big banks at one of their retreats, how come if we come up with $1 million commercial loan that we only get a quarter of the commissions that go with a residential mortgage? And he didn't get a straight answer. And I said to him after, I said, have you looked at the capital weighting on SME loans versus residential mortgages? So you need 4 times the capital to do SME lending, and it's only going to get worse with Basel IV.
George, what's your perspective? Do you think, back to Sunil's point, that effectively this is 9 parts fin and 1 part tech, that effectively you have to cultivate the old-fashioned intermediaries to get business up to scale?
I'm glad you asked me the question because, with all due respect, in the U.S. it's totally different, which may be a difference between the Australian market and the U.S. market. In the US market, if you're not really heavy on tech, you don't stand a fighting chance. So I think that it's not to say that one is right and one is wrong. I'm just saying that it's different. So I think in the US market, one of the big questions whenever you're evaluating an investment is this company really, did they start at fin and add tech? Did they start at tech and add fin? How are they balanced in those two things? And I think the best, the greatest, the most successful leading companies in the US are either started with tech or are really super strong in tech. And it's not just the underwriting. It's also this thing called profitability. It is extremely hard to control your costs if you're not very heavily in tech and if your mission isn't to automate everything in your supply chain of your internal operations as much as humanly possible. People and advertising marketing are the two biggest expenses in the fintech space in the US, and they're the two biggest things that are holding back profitability of platforms. You need tech to solve both.
Sorry, go ahead.
Yeah, I just think so. I'm not put in the same bag. We do a lot of tech. We have a risk model. We have a joint venture with another company called Veraluma, which is essentially Defence Force Intelligence that we've then modelled it, and soon that's to be customised and to be spun off on itself. But for us, it's actually putting data into data points to get our risk model and doing something which I don't think a risk officer can do, is taking multiple different levels of decisions to get a result. Then on the other side, we actually do the tech for closing and checklists and formulates and APIs to go through there. The only thing I would add is that I think it's a bit of a balance. You use tech to help you with your customer relations. You need to still also have the customer relations.
Yeah,
if you try to use tech alone, and I think this possibly may be an Australian thing too, you try to use tech alone, you'll get there, and I've had comments, people say, I'm glad to see there's a human voice behind what I...
You're 100% right. The companies that tried to go like 100% tech or close to it didn't make it in the US.
So very quickly,
once again, I think it's a different perspective we're looking at here, because if you look at an investor's perspective, you're looking at profitability, you're looking at scale, you're looking at, I guess one should be looking at defaults. Now, if you look at the credit decision, actual making of a credit decision, I would challenge anybody who says that it's being made by technology until such time as there's artificial intelligence. The concept of making a lending decision for a larger business loan without that sort of homogeneous risk profiling would be quite difficult. So I think there would be a fair bit of hype as well that accompanies some of the talking around that tech solution. I think, again, the proof of the pudding would really be in the level of defaults that one sees over a period of time. And going back to your last point where you said there was the fragmented situation of 7,000 credit unions taking care of small business in the US to a large extent, they certainly don't have the technology, but they have the relationship and the credit knowledge to a large extent to do what they're
just
doing.
picking up your default point as the last question. I had the good fortune to be stuck over lunch with a chief kind of risk officer for a very large global investment bank. He was buying lunch, so it was all right. So, and we were chatting away, and I suddenly realised that they have a zero-sum way of looking at the world. Okay, and his view was, he said, rather like actually our colleague from Morgan Stanley said this morning, his view of SME lending was, it was effectively a piece of string, and the string didn't really expand, and you pulled on it. And his view was, you lot are all effectively opening up the market to the riskier guys. Yep. And his view was that effectively, you're laughing because we all know exactly how they think. His view was, we basically have got the fairly safe bunch of customers. Yeah. There's about 10 to 15% of people who don't quite tick the boxes because there's personal circumstances involved, and they're marginal, and they could include them, but depending on how much the regulators beat them up, they don't. And then there's the other hinterland of gazillions of businesses that are frankly all basket pacers. They'd never lend to them, and because they're going to start going to you, or all of you, you're going to basically get walloped with defaults at an epic scale in the next 3 years. And he was busily chuckling as he was saying this, saying that he reckoned that your SME default levels would go up by a quantum of 5.
I met a guy 25 years ago who thought there was a bit of a gap between private equity and senior debt. Today they run $25 billion of intermediate capital. It's called Intermediate Capital Group.
Good, very good business. Yeah.
There are underserved markets out there, and if you're sitting from a bank perspective, you might not recognize it.
But is he right, though, that when the next recession comes along, we're going to see a quantum increase, five-fold increase in default levels?
I think, again, it depends on what niche you're playing with in the marketplace. So I would also suggest that if you look at the default statistics for the SME market space in Australia, and I don't mean loss given default, I mean the probability of default, or people who have been overdue 90 days or thereabouts, it's been between 1.6 and 2.2% for the last 25 years.
But you haven't really, have you, I mean, apologise for my local knowledge here, have you had an absolutely savage recession in those 25 years? Really bad one, nasty one, horrible one?
Well, not in the sense of a systemic one that has changed the economy, and that's why probably we've not been as innovative as the UK.
Yeah.
Westpac didn't nearly open on a Monday in 1991.
Yes, pretty soon.
I'll speak to anyone who was there on the Friday.
Yeah. So, but what would...
Yeah, look, I think it's also a bit about cost. If we're going out there and the only products we're offering to the borrowers is priced at a price that's more expensive than all the banks, eventually you do get a situation where you are the lender of last resort, because that's the only guys you're getting. What we see is with our insurance and the like, we're able to start competing at the same levels. And then with insurance, we would argue that, well, hang on a second, why is the insurer actually willing to cover that debt if it's that type of debt? But of course there's reasons behind those. But I think what's important here is that we don't want to be the lenders of last resort. And it is true that the biggest problem we have is the understanding in the SME world of our product and getting that message out.
The education and brand awareness.
What we see with most of the SME lenders, most of the SME borrowers that we get, is that we speak to them, we talk about the concept that they're now, one, getting someone who gets to know more about their business, and also they're getting a panel of investors, or they're getting a group of investors to give them a better base through the next recession, where they'll be able to deal with it.
That's one very last, I'll go on each one of you. What's the one classic type of business at the moment that is underserved, kind of business customer, that's underserved that you think is a good risk? George?
I think it's the customer that should be given the loan based on merit, but the merit is misunderstood. And by that I mean, we talked earlier about how small businesses are an incredibly diverse group. You can't say they're all the same. So if you don't have a way of analyzing the credit that takes into account the wide variety of SMEs, then you can't make the right decision based on merit. And so I think it's the non-typical SME is the most treated in the market right now.
What would that non-typical look like?
It's quite simple. It's service-based businesses, which are the powerhouse of the economy in any survey, and they've got no collateral except, in many cases, high-quality debtor books.
Leo?
I'd say it's businesses that have been running successfully maybe 1 or 2 years, got good financials, and they need loans between 125 up to say 500,000, and it takes the bank possibly 4 weeks to go and process that, whereas we could possibly get it funded within 10 days.
Sunil?
I'll go out on a limb here and say that what we usually put out on our website is, if you need the money tomorrow, then we are not your guys. Because we really want to deal with people who have planned what they're planning to do and have an understanding of their business and their growth. And to that extent, we use other soft things, like if we can't get updated financials which can be picked off from MYOB or Zero, then again, from our point of view, it adds to the risk weighting. So we use things which are different from general scores, but the business we're looking at is businesses that actually don't have, and to go to your point on services industries, any business that doesn't have a house to give bank and is not getting served for their growth opportunities is where we come in.
Lovely. Okay, can you put your hands together for the panel? Excellent panel. Thank you very much.